Hello friends, in this video we want to talk about the price action. Engulf. If you are not one to simply trade on the touch of a zone, but would rather wait for confirmation that price has rejected, there are some brilliant price action patterns you can look for before you enter a trade. The best ones we'll cover involve an engulf. Simply put, an engulf involves price making a lower low on reaction to supply, or higher high from demand. This is a very powerful sign that price is on the turn. They say that a trend is a succession of lower lows and higher highs, or vice versa. So if you get a lower low from supply, it's a great first sign that the uptrend may be over. And of course, flip the scenario for a higher high from demand. Can you trade an engulf as a breakout trade? Well, yes, but price very often retraces after the engulf. To confuse the breakout traders and hit their stop losses, creating more orders to take the other side of the big money's new direction traders. This means that the stop loss would, in most cases, still need to be beyond the original zone. Fake outs. Fake out is also known as false breakout. Sellers, buyers, bull, bear trap, stop run, stop hunt, and liquidity spike. There are different scenarios and situations of why it happens. However, the main reason behind it is to create liquidity in an liquid market by big funds to test a level's strengths. Let's say price of a financial instrument is rising to a value of significant history at 100 resistance level, where the majority of traders will either buy a breakout with stops below 100 or sell on rebound with stops above 100. The price moves higher to 105, triggering on its way sellers' stops and buyers' order. But price doesn't get any higher and reverses back to 100 before dropping lower to 80. So what has happened here? Big funds were planning to sell from 100, but due to significance of the level, so were the other market participants. So if the whole market is selling at 100, then there are no buyers. If pro money sold at 100, they would get a bad feel as price would quickly move away from their entry. In order to get buyers for their sells, they must create liquidity by moving price a bit higher above 100 to induce buyers to jump in, as well as triggering sellers' stops, which add to the buying pressure. This will help fill their mass sell orders. At the same time, they're able to test if the level holds against the buying pressure. The presence of other bullish big funds would have moved price up with momentum. When pro money started selling, price fell below the 100, triggering buyers' stops, and new sellers jumped in, all adding to the selling momentum. Around significant areas where stops are placed, and breakout traders wait to buy or sell at unconsumed supply or demand zones, at a stacked supply or demand zone, and at the end of the compression into supply or demand. It can be identified in different ways, such as candle close or close of two combined candles in relation to a previous swing high or low, or a support or resistance, or a key level. At 1, price created swing low, then moved up and returned back at 2 in a curvy shape, breaking through the swing low level, but failed to close below, and this is a fake out. Next, price consolidated above the level, retesting if level will hold, then moved up. At 3, another swing low and a return at 4, considering the space and time price took to return at 4 and the acceptable curved shape, price created a fake out followed by a retest and a second fake out before moving up. At 5, swing high and the return at 6 wasn't a good acceptable curve shape. The fake out at 6 was to test if the level will hold, and eventually it was broken. You can see 2 fake outs. one of a swing high level and another of a swing low level. Both cases had an acceptable curvy return to test the swing levels and without having to retest the fake-out's price has changed direction at both levels. At 1, a demand zone that was ignored thus becoming supply, price dropped forming a supply at 2, and an ignored demand pocket followed by a drop and retest of broken support becoming support or resistance flip, and a fake out at 3 into ignored demand followed by another drop in price. At 4, a demand zone was created followed by another demand at 5, and a rally to 2, a first visit to the ignored demand from 1, now supply, then price compressed down into the fresh demand at 5, creating a fake out at 6, followed by a retest and a rally to 7 for a second visit into supply and a fake out of the preceded swing high form, followed by a retest of the fake out and change in direction. Now that ignored demand at 1 is totally consumed, now and 7 is a fresh supply zone. At 8 we have a swing high, and at 9 a RBR demand followed by a rally to 10 and a first visit into supply from 7. Price moved down to 11 into demand from 9, creating a fake out into support from 8, followed by a move up to 12 back into supply for the second visit and a fake out of the preceded swing high at 10, followed by a change in direction. At 13, price returned back to the demand from 4, digging deep into it, and the spike that broke through the zone with a close inside was a clear sign of consumption. In this example, we'll speed up the process and point directly at the fakeouts. At 2, a support point and a DBD supply followed by a drop in price to 3, creating a swing low and a fakeout. The curvy shape could be seen on the lower time frame. Price returned to supply at 4, creating a fake out of the broken support point from 2, followed by a change in direction. At 9, a fake out of the support from 7 and into a low time frame RBR from 6, followed by a change in direction. At 10, a fake out of preceded swing high at 8 and into supply from 2, followed by a retracement. At 12, a tiny fake out of preceded swing low and into demand from 5, followed by a compression up. Note here that recent price reaction to demand from 5 makes of a stacked demand above the lower demand from 1. At 13, compression into ignored demand from 11 turned supply and a fake out of resistance followed by a change in direction. At 14, another visit to stacked demand zones and a spark into the lower demand zone, as well as a fake out of the swing low from 5 followed by a change in direction.